The Money Show.
Personal Finance with Warren Ingram.
Time, of course, to hear from Warren Ingram. He is the co-founder at Galileo Capital and a certified financial advisor. And we're talking tonight about making the most of your employee benefits. If you work for a company, how can you make the benefits that you get work for you? Warren, good evening. And I suppose we need to start with the simple fact that I hope you look at your pay slip every week. We should every month, and notice how much we get paid and how much actually goes into our bank account. And there's a big difference between those two things.
There is a big difference, and it's interesting. I was talking to an employer over the weekend, and he was quite frustrated because he was saying he pays his staff, their salary, and from that big salary, he deducts retirement fund contributions, medical aid, life cover, etc. And when his staff come to him to say they want an increase, they complain about the amount that's in their bank account and ignore all the benefits that he's paying on their behalf. And when he asks them why they're so unhappy, they'll say, well, the employer next door is paying a bigger after tax amount in my salary that goes into my bank account. But then we're not realizing that they're not getting any of the other benefits. And it struck me that I think a lot of people are in this position where we're so focused on what gets into our bank account that we're missing the fact that maybe our employers are paying quite a bit of money for us to the things that matter now, for example, to medical aid, but also matter to our retirement. And I think it's worth understanding what we actually get. And yes, some of the money goes to SARS and that's paying our due, but there could be quite a bit of money going to things that are entirely for our own benefit as employees of companies.
Your questions for Warren on this, 011 883 0702 021 446 0567, and of course your voice notes too, please, on 072 702 1702. All right, let's sort of go through some of them. And I mean, the one we kind of all know is that if you work for a company, there's usually a retirement fund, a pension fund, or a provident fund.
Yep, and often there's kind of a range. So you might find that you join the company, and the company says it's part of our conditions of employment. So it's not something you can opt out of, where you have to contribute to your retirement fund. And important words, you have to contribute to your retirement fund. It's not like the company's taking money from you and giving it to itself. It's helping you to actually save for your retirement. And often there'll be a range. So there might be a minimum where they might say it's 5% at the bottom end, and sometimes it's 10 or 15% of your salary. And if you're with a very good employer, that sometimes the employer will match the contribution that you're making. So if you say, for example, I'm gonna contribute 10% of my salary to my retirement fund, the employer says that's great. We'll match that contribution, and it's obviously not infinite. I mean, no company's got unlimited money, but there'll be a matching of that contribution to a level, and so. If you decide that actually I'm going to do the minimum, if the company says I can take 5% as a minimum, I'm going to do that because I want more in my bank account every month. I understand the drive to increase your pay now, but just understand that if you were contributing 10% and the company was happy to contribute another 10%, that's quite a big saving for your future self, for your retirement. And I wonder how many people are just grabbing the minimum right now to just get that maximum and sacrificing what could be a really nice benefit, into the future.
So, I mean, okay, when they match your contribution, I mean, would that be included out of the big sort of salary pot that you're supposed to be getting? That would be, when they said you were going to be employed by them, that would be part of it? That would be part of the figure you agreed to?
Well, I think it's actually an add benefit. So for example, if they say we're going to pay you, your total, your cost to company number is going to be 10,000 Rand a month. Let's keep the math simple. And you say, okay, I'm going to pay 10%. So I'm going to pay 1,000 Rand of my 10,000 to my retirement fund. The company says, well, we want you to save for your retirement, so we're going to match that. They're not actually reducing your salary from the 10,000, they're actually giving you an additional benefit of 1,000 Rand, which the company is paying. So you're not sacrificing your after-tax salary and making it even smaller. What you're actually doing is getting an additional 1,000 Rand benefit for your long-term retirement. So when they're offered to match, it's quite a benefit. And I suspect a lot of people just don't pay attention to that. They don't really regard it as a real benefit. And to me, it's a fantastic benefit. I mean, I guess it's obvious I'd say that. I'm a financial planner and I want people to get to retirement in a good position. But gee, if you're disregarding that as an employee, I think you really are doing yourself in a bit.
Okay, group risk cover. Often you go in and you join a company and there's a conversation around medical aid. Now you might already have medical aid, or you might already have some kind of fund. Let's put medical aid to one side. Actually, let's talk about the retirement funds. So there's risk cover that you already have, and your company has it too. How do you manage all of that?
Yeah, so it's one of those benefits of being part of a big group. When you decide, I'm going to get life cover for myself, so I'm going to go to an insurance company on my own, and I'm going to ask them for a quote to give me life cover for 5 million rand, disability cover for 5 million, and dread disease for whatever amount I can get. If you compare the cost per million that you would pay as an individual going to an insurance company, and you look at what it would cost you when you're part of an employer group, the employer group insurance is way cheaper, and by like many times cheaper. And the reason for that is, let's say you're part of a company that employs 100 people. Or even more, 1,000 people. When the insurance is now being done on life cover, they're looking at all 1,000 people at once. So there's a big pool, and they're collecting quite a lot of premiums on behalf of all of those people. But also they're now spreading the risks across a lot more people for the event that in the event that something bad happens. So the bigger the pool of people that they're insuring, the lower the premium. And it's kind of shocking, for people who are happy to be employed and happy to have the life cover, and then one day they leave and they decide they're going to just get their own life cover, and they realize what the difference is. And if you're paying 1,000 rand for 1 million of life cover as part of a group scheme, and suddenly that million now costs you 5,000 rand on your own, it's a phenomenal difference. And it's something that a lot of self-employed people they don't really know about until they leave the kind of corporate world and then decide to insure themselves on their own. So it is, again, it's one of those really good benefits. Unfortunately, you can't get sort of unlimited life cover. So it usually will be something like a multiple of your salary. So they might say, if you're earning, again, let's just keep it simple, 1 million rand a year salary, then your life cover will be somewhere around 3, maybe 5 times your total salary, and it won't be a unlimited amount, but still, if you're getting that benefit, just understand that means you don't need to then apply for life cover for that amount in your own capacity. And as I said, it could be a very big saving.
So, I mean, this also ends when you leave the job. Can it be quite difficult to get that level of cover again? Especially because you've probably moved on in life.
Yeah, exactly. So, if you're one of those maybe nowadays rare people that's worked at a company for a long period of time, you joined at the age of 30 and you leave at the age of 50, and you try and get life cover at 50 years old, it's much more difficult and way more expensive than when you're applying at 30 years old. So not only are you now doing it as an individual and not as part of a group, but you're also doing it as a significantly older individual. And life companies don't really want to pay you out. So what they want to do is they want to make sure that they're underwriting the healthy people who are going to live for a long period of time and are relatively low risk for the life company. So you only hit this kind of cold reality when you've left the employment, have no life cover, and then you say, okay, well, let me see what I can do for myself. And I've had that in my life where asking a life insurance company to insure me as a 50-year-old, you can't believe the quantum of tests they're going through just to make absolutely sure that they think I'm going to live for at least another 10 or 15 years.
Well, if we could all just run this sub 2-hour marathon. We're taking your calls and your questions for Warren Ingram, how to make the most out of your employee benefits. 072-702-1702 for voice notes, and 011-883-0702 and 021-446-0567. Okay, medical aids. Now, this is actually quite an interesting thing because you get group rates. So Sometimes there's often a negotiation. Sometimes companies actually force you to go in on their medical aid scheme. They say you really must, which I can understand, I suppose. Sometimes they don't. Sometimes there isn't any medical aid at all. But usually there is a little bit of a subsidy.
There can be. So you could be in a position where the company, to encourage their staff to remain healthy and to maybe get better, if they do get sick or have an accident, they'll often say, well, we want you, and we prescribe as part of your employment again that you need to be part of the company medical scheme. And we know it's expensive, so we'll give you like an additional kind of a top up, as part of your medical premiums to make it a little bit more palatable for that cover. So often that's one way. The other way is if the company is in a specialist industry. So, for example, you get medical aids that only look after accountants or only look after people in the banking industry. So they almost pre-select the people of a particular industry. And what you find is that in a situation like that, the medical aid cover is quite a bit cheaper than a general broad medical aid because the medical aid will believe that, let's just talk about the accountants, to do a gross generalization. The accountants do the sums and realize it's, very dangerous to go, like skydiving and all those things. So they just don't do it. And so they're considered lower risk than the crazy people that do. And so they'll get a better medical aid at a lower rate. And as I say, if you're in a part of a group like that, an employer group, where they're focused on particular industries, you might find that you're getting very good medical at quite a low rate. And so again, just understanding that your own medical aid, doing it on, entirely as an individual, you might be able to match it if you're part of like a generic company that's part of a generic industry, but you probably won't get the benefits of the company, adding to the contributions as part of your employment contract. So I think there are probably two parts there. One, that you might be part of a specific industry and you can't get that on your own, especially if you change industries, or two, that the company is doing a contribution on your behalf.
Okay, so, you are likely to then get, if you go through a company, a cheaper rate than you would on your own. That's the big takeaway here.
And either because the company does a bit of a top up, or because you're part of an employer group, and then absolutely. I've stunned to see how good the medical aids are for these employer groups, with specialist industries. That really good for them. But pity for the rest of us who are not part of those.
Okay, we've got a question for you, Warren. It says, "Hi, I'm 27 years old. I'm getting married in November to my partner. We've been together 5 years. We've been talking about whether to sign a marriage contract or to marry in community of property. We don't understand the difference between a marriage contract or community of property, and we cannot agree on which option is fairer for both of us." If you can't agree, what should we consider before getting married? We'll have Warren's answer. Love advice ahead of Aubrey Masango's special feature on love tonight from our financial advisor, Warren Ingram, in a moment.
The Money Show. Personal finance with Warren Ingram.
8 minutes to 8 the time. Your questions for Warren. We have one or two coming through. But first, Warren, a person who wants to get married, they want to know whether to sign a marriage contract or marry in community of property. They're not sure which is fairer. What do you think they should be considering?
If there are no religious or cultural considerations with this, then for me, this is such an easy answer. And the answer is you have to absolutely get a contract all day, every single time. You just cannot, do the community of property marriage. And just to understand, if you do community of property, if it's you and I, Stephen, we get married, and I arrive in the wedding with 5 million rands worth of debt, and you arrive with 5 million rands of the assets, and we get married in community of property, that means that you now share in half of my debt, and I share in half of your assets as we come into the marriage. So whatever we brought into the marriage, good or bad, we bring, and going forward, we accumulate the same. So if I'd keep going and build up more and more debt, you're getting half of that debt onto your balance sheet, and if you're a good saver, I'm getting half of those assets onto my balance sheet. And if I get liquidated, then the liquidators come after me first, and you second, and you have no protection. So just understanding that it sounds like such a nice romantic idea, let's go in together and we're going to share in everything, and everything will be magic. And it doesn't require someone to behave badly for things to go horribly wrong. So, for example, someone running a business and the business gets sued and goes south, then all of a sudden you're now both sharing in the downsides of that, especially if someone signed a surety for a debt. So I really don't like community of property. I think it's one of those things that it's long standing. It's been in our marriage law for a very long time, but I just don't think it's something we should be doing as people getting married now. You can just get a contract where you say whatever we brought into the marriage, we keep separate, and going forward, we accumulate assets together. So that's fair in that, if one person arrived with 10 Rand and the other one with 100 Rand, whatever we save together going forward, we share the savings 50-50, or you can do it in any kind of proportion. So you can put all of this stuff down, but I just think you can't have a situation where you share everything all the time forever, including things that go horribly wrong. It's just such a bad idea. And unfortunately, because it's the cheapest way to get married, a lot of people are still doing it, and I really wish they wouldn't.
Yeah, I know. There are so many risks. Warren, we have a voice note that's come through on 072 702 1702.
Stephen, hi, good evening. Just a quick question, and I don't know if I misunderstood something Warren said there. If you have group life cover and personal life cover, did I understand him correctly when he said that you don't need both, or did I mishear that? Maybe if you could just clarify that. It seems like he was saying that there's kind of a maximum that they would pay in any case, so if you already have the group, you don't need the private. But I'm not sure I heard that correctly. If you could just clarify that, thanks.
All right, thank you, Warren. If you've got a second to just clarify it.
Great question. So no, I mean, you let's say you've got 10 million rands worth of debt and your company gives you 5 million rands worth of group life cover, then absolutely you still need another 5 million rand, which you should get yourself. But for example, if you've only got 5 million rands worth of debt and you don't need any other life cover for any other reason, then you can cancel part of your life cover that's in your own name, the personal life cover, and just use the group. So it doesn't negate your financial planning that you still have to do. It's just that you shouldn't ignore the group life cover as part of your whole financial planning. It's certainly going to be your cheapest form of life cover.
We're going to try and squeeze in a last voice note quickly. Here we go.
Hello, Stephen. So in my company, the total cost to company is given to you upfront. Part of your contract, it's stipulated in the contract, the company's contribution is 10% of the total amount that is given to you towards your pension fund, and a certain percentage is towards your medical aid and the life cover. From there, you then decide on your own how much you want to top up to what the company is already contributing. You can either match what the company is doing, which is 10% of the total amount that is already it cost to company. And you do the same with the medical aid. If you want to just work with what the company is contributing, you get the basic, maybe medical cover, and then it's the same with the life cover.
All right. Yeah. Okay. I think I get that, Warren.
Yep. And so just when you're doing that calculation for yourself and someone else is giving you a job offer, just have a look at all of the things that the company's paying on your behalf when you do that calculation to say, am I getting a good deal or not? Because it sounds to me like you're getting a very good deal.
Okay. I mean, I suppose this is really the thing, though, isn't it, Warren, is that we've got literally 30 seconds left. But if your boss offers you an increase, say 5%, what do you need to be looking at when it comes to the benefits?
Yeah. And so just when you're doing that calculation for yourself and someone else is giving you a job offer, just have a look at all of the things that the company's paying on your behalf when you do that calculation to say, am I getting a good deal or not? Because it sounds to me like you're getting a very good deal.
Okay. I mean, I suppose this is really the thing, though, isn't it, Warren, is that we've got literally 30 seconds left. But if your boss offers you an increase, say 5%,
Don't just look at the amount that's going to, land in your bank account. Look at, has your retirement fund contribution also been increased? Is your medical aid subsidy doing the same thing as well? So it's just understanding that you might be getting a lot more benefits than you realize. And it's not just about what lands in your bank account at the end of every month.
Warren Ingram, thank you so much. Really do appreciate it. The co-founder of Galileo Capital, a certified financial advisor. Financial guru, I suppose we should say. Interesting, we'll podcast this, of course, because there's so much to sort of consider when you look at your employee benefits.